So this is an open question to anyone. In terms of pricing, are we solely looking at the number that you put up on the invoice as the premium, or are there variations to the pricing, other components that you can bring in to make sure that your insurance rate or your premium rate or your price is commensurate? So I'm trying to say, instead of just looking at the final invoice amount, are there other components that you can play around with to make sure that at least you are not prejudicing the insurer, or you are not prejudicing yourself as the underwriter?
Okay, Simba, thank you. I think, yes, there are components which basically are in control or from the underwriter. For example, the underwriter is in control of the management expenses, so to say. So because there is sort of management expense you can actually control at one point of the time if you work out your number. So to me, that is aspect of the premium or the price which you can play around for the purpose of accommodating the client.
What we've seen is that you can also incorporate your NCDs, your no claims discounts, to say, no, look, if you're not going to have a claim, we'll then give you a certain discount, or we have your long-term agreements to say, no, look, we'll tie you down for the next couple of years, and if you don't have a claim, you're going to get a certain discount. Even to such extent, I think some other policies we've seen issues to do with even issuing out a profit commission on a policy to say, if at the end of the period the risk has been profitable, there's something that goes back to the insured.
Okay. Now, we sort of agree that the rate is flexible. Other markets are open. You charge what you want because it's a free market. Other markets, there's a reference to a minimum rate. Where does this issue of rate undercutting come from? Yeah.
I would say that it basically comes from the to get competitive advantage. Most of the clients just want to grow their book, just want to get to the top of the ranking in terms of market share, and they don't really analyze the type of rates that they are giving to the clients, because they just want numbers. At the end of the day, they are not really worried about reserves. They are not really worried about their honoring their claims. They are just worried about their top line. And what happened is that in order to get the clients, the premiums start being undercutting. It becomes a practice where a client goes to company A and they say 0.1. When it goes to company B, they say how much they gave you there. Okay, I will reduce it by 50%, and it goes on and on. It is something that it's happening here in the market where I'm trading now, and it is our daily coffee. So premium undercutting is really a serious issue, because at the end of the day, it really affects reserves. It affects even our ability to honor claims.
Yeah, Sharon, so if we've agreed that there is no correct rate and there is no statutory rate to price, where do we come from to say so and so is undercutting?
Good and pertinent question. So, like I said, yes, there is no good or bad rate, but still we need to have enough premium to be able to honor the claims at the end when we get the claims. So if we give a too low client, then the amount of premium in our pool would be not enough to honor all the claims. So we need a minimum that would be able to make that pool end up on a positive note at the end of the year.
Yeah. So Charles, the reason why your market ended up saying we need minimum rates is exactly what Sharon is talking about. To say, in terms of the insurance market itself, we are no longer looking at the client as a unit, or we are no longer looking at the insurance company, but we are looking at the industry as a whole. That in order for the business to be sustainable, the industry as a whole is supposed to raise a certain minimum amount of premiums. right? But still, my question is, if your client goes to the next office and the next office decides to say, okay, it's fine, I'll give you a 20% discount. At what point do we judge that to be undercutting?
Yeah, basically we just that is undercutting where there is imbalance between the risk exposure and the premium charged. Yeah. How can you determine then that there is imbalance or the premium charge is not commensurate? Because you will basically look on the market trend. You look on the loss experience of that given class of business or that class, that specific client. Then you come to realize that the premium which I have charged basically it's not worth it for this client. Yeah, for example, perhaps you are underwriting a fleet of motor and looking on the experience, they are on 70-80% loss experience, depending on the premium which they were paying from the other market or the premium which they have paid this year. If you charge lower than that, then you will feel that you basically undercutting.
A very good point, Charles, because I think the first point you are bringing to the table is that the premium that you are collecting is supposed to be adequate enough to pay claims. So the moment you start collecting less premiums or collecting premiums that is not sufficient to cover your claims and expenses, for me, that's the definition of undercutting, with or without involvement of competition. But Kelvin, just to come to you also on that notion of undercutting. Yeah, two big elements there. Is the claims and the management expenses. And one of the elephants in the room on the management expenses is commissions. Can you maybe part of your explanation also touch on the commissions issue also?
If I may start from the issue on rate undercutting, my understanding is, adding on to what Charles had said, is to say, undercutting is when a risk is priced below nominal economic levels to such an extent that it then becomes unviable to underwrite that particular risk. In comparison, I'll give an analogy to say, I think in law they talk of the reasonable man test. I think for us it will be purely based on, if I may equate it to a reasonable underwriter test, to say, does it then pass that test? If it doesn't pass that test, then ultimately it can be perceived as being an undercut risk in terms of the rate. And then coming onto the issue of commissions, I think that's one of the most topical issues we're having in the market, whereby I think we've seen commissions being on the higher side, despite there being regulated commission levels that have been gazetted by the regulator. But I think of late, what the regulator has then said is to say, I think the way the commissions are now creeping into the premium that is ordinarily supposed to remain as your risk reserve pool. So the commission has actually gone forward to say insurers should then stick to the regulated commission levels that are in the market.
So, Iara, one of the issues highlighted by Kelvin and Charles is that the price has to relate to at least to costs, and there has to be a minimum benchmark below which you can't go as an underwriter. For example, if you are in Mozambique, everyone knows the price of bread, the price of bread, not necessarily the same price in each shop, but at least there's a benchmark somewhere. One of the reasons is that the cost of the inputs into the production of bread is known to everyone. Now, one of our biggest problems in Africa is information. about underwriting information. How do you view that in terms of affecting the rates that we then see on the market?
Okay, one of the main issues is competition.
Mm.
We are not playing at the same side. We are not together. So if I get a risk, I don't share with my colleague from the other company the issues that I had with the same risk.
Yeah.
Probably the client had the claim and moved to the other company and goes to the other company and receives a discount.
Mm.
Discount for what? For claiming? So the main point is, as long as we keep acting like we are fighting, we will not move forward. At some point, we need to get together, understand that we need to protect our markets in order to move forward, and act as one company, not isolated silos. That's the main reason why today we have the problems that we have in terms of rate undercutting and all issues related to rates dropping years over years.
Yeah, Iara, I think that's a good wish. But why should I play on your side if we're competing for the same business? What do we do about information? That's one of the key inputs. You try and business, you try and underwrite business, you find that your insurers, your underwriters, no one is interested about loss history. No one is interested about what are the particular circumstances of the client.
The client, yeah.
Underwriting and accepting risk. Sharon, what do we do about it?
To maybe have some trainings or more conferences to discuss about like what you're trying to do, Simba, like some kind of conference or discussions on the issues that we are facing in the market, because at the end of the day, if we continue like that, we don't cooperate and share information, underwriting information, then it is our market which will be affected, and company as well. And even if we like competition and business, but it needs to be at the end of the day a healthy competition where we can give a price which is appropriate for the risk, and even give a discount where it needs to be given, not like Iara said, give a discount when the client made a claim.
Charles, you seem to be agreeing as well.
I do agree with Sharon. However, the problem of undercutting, I think it should be viewed industry-wise, because you know why it happened, because each insurance company or reinsurance company has its own targets and objective for the specific period of time. So that goal, that object, that is what pushed the company to do the undercutting or not to do the undercutting.
Yeah.
So I think it should be a market agreement that our competition should be on service, not on pricing. Yeah, that
I agree.
Whoever service the clients better will get the clients, not on undercutting the prices. So I think it should be an agreement, a market agreement, and of course perhaps it should be it should be enforced perhaps by the regulator, but I don't know. We are in free business, we are in free world, so I don't think it would be better if everything the regulator intervene. But I think as professionals we need to sit and talk, because you can't have an account today and that account make you lose money, then shift to another company and make that company lose money again. It keeps rotating. So I think it should be, as a professional, we should sit and put some ground rule on how to deal with this sort of thing.
Yeah, Charles, I think also that's a good wish, but your clients, I think, and you know, consumer rights groups won't agree to you to sit down and collude, you know, to punish your clients. Kelvin, what do you do about this?
I think what my fellow panelists are saying is quite correct to say there has to be some form of agreement. Probably I'll just pose this as a question to the fellow panelists in terms of how has been the prevalence of completion of proposal forms, because ultimately that's where we get the underwriting information from in terms of your previous insurer, your previous loss histories, and that then becomes the basis, because it's a document that then forms part of the insurance contract. And to then say if any claim happens and it is at parallel with what you have stated on your proposal form, then that means the insurers have every right to repudiate that claim. So just to find out how has been the prevalence in your markets regarding the completion of proposal forms. I would say from Zimbabwean perspective, I think it's one of the sticky points that we have in terms of clients not willing to complete forms or paperwork. But interestingly, if they walk into any bank, they are asked to fill 10 pages to open an account, they'll gladly do that. So I don't know what has been your experience in terms of.
In terms of proposal forms, you don't see them, but wait for the claim forms. The claim forms are there, fully complete. You know, at placement stage, no, it's difficult to get the client to fill the proposal form. Please, can I have indicative terms? But when a claim rings, you have a complete claim form, I can assure you. But the proposal form at all, no.
Yeah.
Sometimes you can get the proposal form, but again, you get the wrong information because you have nowhere to verify that information. The other company perhaps won't give you the access to the previous insurance information. So it becomes a very, very challenging. So I don't know. Yeah.
So for me, I mean, look, my question would be: are we innovating enough? Are we evolving enough? Because my perception is that the environment of controls is slowly being rendered ineffective, right? There are other industries that are cropping into the mainstream insurance industry. If you talk of fintech, you talk of the banks, you talk of, you can talk of a wide range of innovative solutions that are coming on board. And if we are getting stuck on the control environment, I think sometimes we may miss the mark. My question is the insurance industry innovating enough in terms of how we collect information, in terms of updating our underwriting and pricing models? Are we innovating enough to make sure that one, we survive, and two, we keep collecting enough to cover our risks?
I think we are, but we have to up our games. Yeah, we are somehow innovative, but we really need to push more because the world is moving very, very fast, and if we don't put ourselves together now, we'll be left behind. So we really need to up our games.
Regarding innovation, I've seen that in some sectors, like some cedants are starting to set up platforms where the insured can just enter the information, so that instead of filling in proposal form, like we said, proposal form, it's very difficult for them to fill. I don't know why. But some cedants now offer a platform where they can enter the information from their home without going into the different branches of a cedants, and it seems that slowly it's getting into the market. And I hope it continues, because then the information will be online and easily shared with reinsurers as well. And regarding rating or quotes, I've seen that some, if you can fill your information online, an instantaneous quote if your answers are just standard and yeah, for simple insurance like medical or health insurance or motor as well, they can easily obtain quotes instantaneously from an online platform.
I totally agree. I think a lot is being done in the insurance and reinsurance space in terms of innovation. I think there's been a lot of concerted efforts in terms of creating databases. I know in Zimbabwe we do have a crimes bureau, whereby if citizens then supply information in relation to let's say possible fraudulent claims, and they're then kept in a database. And also from an insurance or reinsurance space in terms of maintaining data, I think gone are the days when we used to keep stacks and stacks of files. I think we're now moving into cloud space, whereby data is then stored on a cloud and you have the information that you require for a particular client from the click of a button. Even if the client was with you 5 years ago and they moved to another insurer, you can then still bring up the data in relation to how that particular client performed over the duration when they were still with you, rather than trying to go into your archives and trying to look up a dusty folder. Thank you.
Yes. So although slowly, but we are trying to move to a more digital way of doing things.
Yeah.
Actually, there is a company here who developed like an aggregated website in order to get the end consumer loading data and get terms from different companies. They are still, it's a beginning stage, and they are trying to sell it. It is not easy, but they are trying to sell it.
Yeah.
And then we are also seeing insurance companies now having applications in order to get quotations, to place a claim, and even to get more information about the company. So it is moving. Slow, it's a bit slowly, but it's moving. I believe that in the next years, if the situation will be.
Thank you, Iara. So Kelvin, you spoke about the reasonable underwriter, which we assume everyone must be, meaning we must at least strive to collect enough to pay claims and to pay expenses. There must be long-term consequences of being an unreasonable underwriter. There must be consequences to undercutting in the long term.
Yes, obviously. Like earlier mentioned, the first effect is purely then on your reduced revenue, because at the end of the day you're not collecting as much as you should, and then that then brings in a knock-on effect to say, if you're not collecting as much as you're supposed to be collecting, that means you may not be in a position to then meet your obligations vis-a-vis your claims when they come through. And once that then happens, you then even have aspects whereby you have reduced profitability, because at the end of the day you do not have sufficient revenue. You haven't collected or priced your risks accordingly. And this has an effect to then say, when we now look at the market holistically, to say, when we then aggregate the players, that then even affects the market loss ratios, because at the end of the day, for the same number of claims, you have collected less premium per se. So when you then aggregate your premiums and your losses, you then find you then have higher loss ratios, which then also has a knock-on effect in terms of then saying, it then when the actuaries then look at the data and say, no, look, your insurers are not making money, your products are not priced accordingly, it then forces then the prices to go up, in terms of then saying you then disadvantage those that are already contributing adequate premiums to your pool. So I think that also then speaks to issues to do with you don't have your illiquid, you don't have your liquidity challenges, and then move on to cash flow underwriting, which is in itself creates more problems.